you. Okay, so with that, hello and welcome officially. We are so glad that all of you are here today for what we anticipate is going to be a highly practical session on what successful fundraising actually looks like in execution, not just in theory. And, as we all know, fundraising isn't about chasing meetings or hoping the right investor shows up. It's really about structure. Because when founders approach fundraising as a focused, essentially time-bound sprint, and you have the right preparation, then that's when traction can really turn into confidence. And then that confidence turns into capital. So today's workshop is designed to give you that structure. You are going to learn how to run a disciplined 12-week fundraising sprint that organizes outreach, builds momentum through those investor updates, and uses real benchmarks to understand, so that you can understand quickly what's working and what is not working in that 12-week sprint. So we are going to dig in deep into what being investor ready really means today in 2026, whether that's clear acquisition and retention signals, or it's a credible story and a tight narrative that really, is connecting your traction to your growth. You'll also work through how to refine a concise 10-slide deck that highlights momentum, market opportunity, and the metrics that matter at your stage. So, I know the goal here today is not just to help you raise, but also, to help you make sure that you have some real clarity and consistency, and, most importantly, the confidence so that you really understand your numbers, your story, and your next steps in fundraising. So with that, we are, we're so excited to be joined by Bhuva Shakti. She's the founder and CEO of Wallet Max. She is a longtime member of the Fourth Effect. She's an investor in the Fourth Effect. She's a seasoned executive with decades of experience across capital markets, investor relations, and enterprise risk. Bhuva has worked at the highest levels of global finance, and now she focuses on expanding fundraising access for high growth, impact driven startups. And so she's bringing that rare mix of the institutional rigor together with real founder first insight. Okay, so I will turn the stage over to Bhuva very soon. And I guess one last little housekeeping before I tell you about the Fourth Effect and then hand over to Bhuva. Questions, you're probably going to have a lot of questions. This is a meaty topic. Please go ahead and share your questions in the chat. Kat and I are here. We're going to be paying attention to those questions in the chat, aggregating them, and we'll make sure that Bhuva gets those questions. But, if you can save them, put them in the chat, then she will address them at the end of her presentation, because there's a lot she's going through. She might get to your question. Okay, so before we dive in and Bhuva takes over, just a very quick word about the Fourth Effect. So the majority of you who are here probably have already heard me say this. You know about the Fourth Effect. You might be inside our platform as a startup founder, as an executive, really making full use of the community and of the resources inside the platform. But if that's not you, you might be part of, our community. You're following us on Luma. You're coming to these public events, but you don't really know what you're missing. You don't know about all the other stuff. Then we would love to tell you about it. And we would love to get you to start your 30-day trial, come inside, come experience the Fourth Effect, all the value, and really see if we can help you, if you're a pre-seed through Series A startup founder, help you think through and understand the strategy connected to your advisors, whether they're informal, they're formal advisor relationships, your advisory board, also your governing board, give you some strategies, some guidance, some frameworks so that you know what you should be thinking about when it comes to your governing board, when you should be thinking about it. We have all the tools, the knowledge, the education, the resource to help you be strategic, figure out who's missing, who you need around your table, how to find that person, and then how to put the right relationship in place with that person. So that is what we're helping you do as a startup founder. And of course, we're helping you that, that's largely connected to fundraising as well, whether you're taking those checks from angels or you're trying to get some maturity and some structure inside your startup so that you can attract institutional capital or other capital. So we are there to help you. So if you're a startup founder and you are not taking advantage of this, come check it out. If you are on the other side and you want to help startups and you want to go be an advisor, you want to be a board director, you want to write checks, you want to earn equity, come join us, because that's what we're doing for you. So we can show you exactly how we do that. And I know we've shared in the chat the platform tour. That's the kind of top of the funnel, easiest way to come in and get started. I lead them. I do them twice a week. So, and if you are someone who's like a longtime member, you could use a refresher. Don't be shy. Come to a platform tour. It's for you too. And we'll just make sure that you know everything and you're getting all the value you can get. Okay. So with that, enough about me. Now I want to turn this over to you, Buva.
Thanks, Breen. Thanks for a great introduction. Let me start sharing my screen first. All right. Hope everyone can see my screen. Thanks for joining us. And thank you, Breen and Kat, for having me. I've been part of both of it for a very long time, as an investor and as a member as well. By way of background, I'm the founder of Walletmax. I'm a startup advisor. I focus on expanding product and operations and end-to-end fundraising. But prior to that, like Breen mentioned, I spent more than 25 years on Wall Street, working at the intersection of technology, finance, and operations. But today I work in the angel and venture capital ecosystems. I'm an investor, angel investor, and an LP in a venture capital ecosystem, as well as I help founders launch products, expand markets, and attract investors. In addition to workshops like this, I also run a fundraising mastermind sprint. And this is my proprietary framework, which is a 12-week plan where you can get from point A to B in a time-boxed, hands-on approach. I also provide ready-to-use templates, software tools, and definitely make introductions to angels and VC investors if I think you are ready. And also scan the QR code to see how the program is structured. And we have a next cohort starting on February 18th, which is next week. So if you want to join, please check it out. Now, in terms of Walletmax, it's a community of 2,000 members, and we are growing every day. But our only mission is to expand fundraising access for startups, because the goal is not about whether the startup has a good product or a solution, the investors are finding it relevant. The major challenge I have seen in all my life is, do you have the opportunity to even get in front of investors? And that's where we focus on, building the pipeline for investors, but also providing opportunities for startups to be in front of investors. Beyond that, you are able to showcase your product, your technology, and solution. We've also invested directly in 10 plus startups. We are open to a wide range of members, and we've had 60 partners as of last year. So check it out. Ask me any questions. Now let's get into today's topic of Tech Founders Sprint for Investor-Ready Growth. More so, a lot of product-based, tech-oriented, and today everything is AI. Those are the startups that are trying to fundraise, especially in 2026, where the fundraising cycle is a little bit longer than the usual, but investors are still deploying capital. So let's take two founders, a founder one who's doing outreach, whenever they remember, more sporadically, randomly, sending updates to investors, and keeping investor notes more unorganized in 5 different places. But consider a founder two who runs a weekly pipeline review, has a standard follow-up cadence, and logs investor questions like customer feedback. That's the kind of structure we are talking about. It's not structure for the sake of structure. It also protects your energy as a founder, because you have to run a business while you're fundraising. You can't stop running a business and go to fundraising and switch back to running a business. So how can you preserve your own energy with a 12-week sprint? You have a typical start date. You have a set of weekly deliverables. You have a clear close window. And that does two things. It creates urgency on your side, but it also signals seriousness on the investor side. When you treat fundraising like product execution, it's structured, time-bound, and also today investors, especially in 2026, they're taking longer to decide. The average time to fundraise to get a decision, whether it is a positive or a negative, is 60 to 90 days from the first meeting to getting a commitment. Now, following a sprint approach compresses these timelines so that you can get to the next step much faster with everything you need before meeting an investor. Pitch deck is one thing, but there are so many other things you need to make a successful fundraise. In terms of building systems and processes, having the fundraising process more repeatable also helps you across multiple rounds. Maybe you're raising an angel round today, you'll do a bridge round later tomorrow, or a VC series or a growth round. Building a system that's repeatable helps you to use that across multiple rounds, or even within the same round if you are fundraising from different types of investors. Maybe you don't get one single check from one investor. There are multiple investors involved. So a repeatable system gets you much closer and faster, preserving your energy to run your business on the side also. In terms of investor readiness, like I mentioned, there is still capital being deployed, but the diligence expectation is very high than what we had seen in the last few years. That means we need to get the investor attention much quicker. We need to show traction in a way that they are able to de-risk their investment when they see it. Both angels and venture capital investors, they want to see the same thing. Does the founder know what is working, what is not, and do they know what they will do next? That's why your acquisition and retention metrics matter. Customer acquisition data is where you start your growth journey, but then retention data is what tells the investor that the customers trust you and there is stickiness. Piloting and the proof of your pilot also demonstrates market validations. Sometimes you may just have customer traction, not revenue traction, and that could be suitable for angels. But when you have additionally revenue traction and a clean cap table, you can bring other types of investors also into the mix. So for our session today, the goal is not to finish fundraising, but rather have a plan that accelerates our fundraising journey starting from today or even this week. We don't have to wait. When we get into the 12-week fundraising sprint, consider it into 3 phases. Of the 12 weeks, we have prepare, which is phase 1, then engage, phase 2, and then finally the closing phase, which is phase 3. The phase 1 preparation sets the foundation. It's more prep work that you do internally with your customers, with your team. Phase 2 is where you outreach and engage with investors, building momentum. Finally, in phase 3, you do the closing. Sometimes the closing may not be positive, but then you won't be starting from week 1. You will have week 12 of work that you have accumulated, which you can continue into week 13. One of the key things in all these phases is accountability is critical. Each week should end with a short metrics check. Metrics are really important when it comes to fundraising. How many updates have you sent? How many new introductions to investors have you made? Have you answered all investor questions? No question is irrelevant, but also apply your own diligence. If 4 investors ask the same question, probably you can go back and tweak your pitch deck or other materials instead of pitching to a 5th investor and getting a no or a delay in the next meeting. A quick exercise is also pick a week 1 start date, put it on your calendar, and if today is more like the orientation, consider next week as your week 1 if you want to do it. So that's how easily you can get started. You don't have to wait 4 more weeks to get started on your week 1. When we go into phase 1 preparation, which is week 1 to 4, typically I encourage founders to think in 3 buckets. First is investor alignment. Who exactly is the investor profile that fits your stage, sector, and the check size? It could be different today, it could be different in few more months, but take a stock of where you are currently, what sector suits you, maybe multiple sectors suit you, and what is the typical check size you're looking for. It could be one check or multiple checks from different investors. It's really important to define your target investor profile. Build a list of 50 to 100 prospects. That's all you need. Please don't try to create thousands of prospects. You'll be spending your time chasing leads that may not even respond to you. Creating a targeted list of 50 to 100 is what we really need to get started. Then having a 10-slide pitch deck, it may not be perfect, not be fully complete, but having a draft that could accompany your outreach is really important to get started. Focusing on quality over volume is critical during this investor list creation. It's really important to spend time during the preparation phase to find the right type of investors. Now, the second bucket during preparation phase is proof assets. What are your traction snapshots? Do you have pilot stories, customer testimonials? Verify all your acquisition and retention data. Document your pilot proof success or even failures. What are the lessons you have learned? This is the phase where you also prepare a data room. Have an outline of the data room. It may not have all the materials, but having a structure in place where you can keep adding materials as you go through the outreach is sufficient. And having funding milestones. If you have a team, ensure that your business milestones are also aligned along with your team to funding milestones. It cannot be a separate business operation done by your team and you as a founder or CEO trying to fundraise in a different type of milestone. It's really important that you and your team align between business milestones and funding milestones. In the preparation phase, the third big bucket is the communication cadence. What are the different templates you use to notify investors? First communication, second communication, how can we measure that? And when you have this ready in the phase one, between weeks 1 to 4, don't try to outreach an investor immediately. If you have advisors in your company or if you know mentors that you have been working with, even 1 or 2 mentors or advisors, review everything with them so you can iron out some of the known issues before you talk to investors, because once you are in a meeting with the investor, it's really essential to get a second meeting. That should be the goal, and not really go back and revise your materials, because sometimes you may never get that second meeting. So that's also really important in phase one. Now, when you go to phase two, this is engagement. We've created a list of 50 to 100 potential investors. Now we begin outreach. When we say outreach, it's really not about blasting thousands of emails. It's starting with warm introductions, because when you have warm introductions to investors, even a couple of them, they help you test your message in low friction environments. Then obviously you can layer in a cold outreach once your tech is stable and positioning is working. But always, whether it is a warm intro or a cold outreach, personalize each email to the investor and have a follow-up. Don't try to send generic emails, because typically they will get filtered out by spam, or your investor may not pay attention because they read 300, 400 such emails every day. For you to stand out, it's really important to personalize. And even if the investor has not responded to you in week 5 or 6, continue to send weekly investor updates. It takes a couple of touch points for them to respond to you once they see that you are really serious in fundraising. It's also important within week 6 that you are scheduling your first set of calls. Between the time you start the outreach and schedule the call and the time when the call happens, don't try to be dormant. It's really important to continue to share metrics and customer testimonials with investors on emails, so that when the meeting happens, you have them prepared enough that they can understand beyond your pitch deck. It's really important to maintain the investor communication flow. And every investor communication or conversation through emails or in person or over Zoom or phone calls, they are more focused on data points. Of course, problem, solution, everything matters. We'll go into that when the pitch deck review happens today. But if 3 investors are asking the same question, then try not to answer it in 3 different ways, but go back to the drawing board, to the preparation phase, fix your pitch deck, tighten the narrative, update the materials once so that you get more successful second meetings with investors. The goal is not to get 10 first meetings. The goal is to convert at least a couple of those first meetings to second meetings. So the less time you have in back and forth, the faster you can try to get to that second meeting. Now, when it comes to the final phase, which is the closing, which is the weeks 9 to 12, we don't want to, again, keep repeatedly starting to engage those 100 investors that we had shortlisted in week 1. The goal is to identify top engaged investors. Maybe out of those 100, 10 responded. In phase 3, between week 9 and 12, spend time to engage only with those top 10. Don't try to create additional set of 100 investors because 10 of them have expressed interest. Answer their questions first. Send them updated metrics, schedule deep dive calls, finalize any last minute items in the data room. Have your needs and asks in terms of valuation and terms of conditions so you are ready with your legal team when the investor presents a proposal so that there is no time lost in communication. And definitely it's really important to define what success looks for you at the end of week 12. Ideally, it is closed capital, but sometimes it's strong verbal commitments plus a near-term close. Even if the round doesn't close in 12 weeks, founders will have concrete outcomes in terms of warm leads, refined investment materials, bridge opportunities, and some next step commitments on the next set of steps to do in terms of closing. So to summarize, during this 12-week sprint, how can we track progress? You're running a business and also fundraising both at the same time between you and your team. Sometimes it could be a single founder trying to do everything. So it's really important to have a weekly metrics dashboard. It could be a simple spreadsheet. You don't need any complex or fancy tools, but there are a few things you need to track on a weekly basis. Number 1, you need the outreach count. How many you outreached? What is the response rate? How many calls you booked? How many calls really happened? And after the calls, how many investor follow-ups you sent? How many times you revised your deck? And also on a weekly basis, are you still keeping track of your traction? Because your business traction is something you need to really keep on top of things while you're fundraising, because that's also an important metric where the investor wants to know, are you just focusing on fundraising? Are you also successfully running your business in parallel while you're fundraising? These are really critical items. You can create a simple spreadsheet, put on a weekly metrics review, but track them on a weekly basis once a week, maybe take 15 minutes on a Friday or something like that, so that you know where you are headed and what are the lessons learned. It's also important that on a weekly basis, when you are talking, outreaching to investors, when you send those updates, investors are looking for a change in your customer traction indicators. If you have customer traction numbers from week 1, it should have changed for better in week 10. So relook at that. Don't try to copy paste the same content and send it out. But even if the customer traction has not happened, try to have an explanation of why it has not happened. Maybe it's seasonal, maybe something else is happening in the economy or the industry. But having a point of view on why your customer traction is stable, growing or not growing, or is going negative is also important when you send these weekly updates. Now, let's look at a quick blueprint of investor ready deck. I want to reset expectations about pitch decks. The thing is, I'm an investor myself. Investors do not read them line by line. At the start, at least, they just scan them. You maybe have like 3 minutes of attention before they decide whether they want to have a first call with you or not. So the purpose of a 10-slide deck is really to focus on what each of those 10 slides are, and do they have a huge impact on the investor decision to have the first meeting with you. Focus on these 10 core slides first. It's a good start. You can have as many slides in your appendix, that's no problem at all. But try to focus on these 10. And then one important thing is, when you are sending a pitch deck on email to multiple investors, try not to send a huge deck with all appendix materials. Also, try to ensure you protect your intellectual property and sensitive or confidential data, if anything. Investors typically do not sign NDAs before or after meetings. So it's really important for you to protect your own privacy and property. So have 10 simple slides, write a personalized email, and when they express interest, you can go with additional materials using your data room or additional pitch deck appendix slides or more financial data and others, depending on what they ask. But what we need is typically a title slide, a problem solution, market traction slide, business model, team growth plan, ask, and close vision. Close vision is really important. Okay, once you close this fundraising round, what is your vision to generate an ROI for both yourself and your investor? And it's also really important to have a proper flow that mirrors investor thinking. So first, the set of slides will typically talk about the problem. Then they talk about the solution. We talk about the market. Is it real? Do you have proof of traction? So having a sequence in terms of how the slide flows is also really important to capture investor attention. If your deck jumps around or overloads slides, investor assume that your execution may also work the same way. And your deck is not a static deck, which means you always have room to go and tweak it based on investor feedback, but have the first 10 slides in such a way that they are able to pay attention and ask you for a meeting. That's the success of a 10-slide deck. Within the first 3 slides, like I mentioned earlier, it's about getting that attention within the 3-minute span that they are trying to scan the slides. Start with the problem. Definitely, we want the investors to understand the pain that the customer faces, that they are willing to pay for your solution. Investors should be able to repeat your problem in one sentence using one simple data point paired with a human example. That's how simple it should be. Adding more data and content really doesn't move the needle in terms of getting investor attention. If anything, it kind of works more in a reverse capacity. So you're showing that the problem is both measurable, meaningful. Definitely also end the section with why now. Why does this problem exist today in a way that it did not exist, let's say, 5 years or 10 years or even 2 years or even last year? That bridge is what strengthens the solution that they have to invest today to capture the momentum and the uniqueness of your solution. Now, when it comes to slides number 4 to 6, which is typically about solution, market, and traction, we need to show that the product solves the problem. Instead of writing a lot of content, try to put a screenshot, a demo clip, or a before and after outcome that emphasizes to the investors as to how the product solves the customer pain point. Let's also not try to create 10 different pain points and 10 different solutions. Pick top 3 pain points and how your product addresses before and after, hopefully with a demo or even screenshots. Acquisition, definitely we need to show retention, stickiness of the customer. Even small consistent numbers will matter when you run these pilots. And investors will also really look for if there is potential for market expansion. They want to see a reachable beachhead you can win in the next 12 months, not more than 12 months. Obviously, there is room for growth, but we need to see traction and some ROI or break even in the first 12 months with outcomes and metrics so that it can exponentially scale beyond that into the second and third year. So that's what slides 4 to 6 are going to do for us. And the last set of slides between 7 to 10, it's all about the team, your business model, what's your funding ask, and what will you do when you close the round. Most times investors bet on the team, the founders. So your team slide should answer one question clearly. Can this group deliver what the pitch deck promises, right? Team titles are not as relevant, but adding relevant experience, complementary skills between team members, having selective advisors on the slide, not everyone, that will really give the confidence to the investor that, yes, this group can execute whatever is described in this pitch deck. And when it comes to business model, they really want to know only the paying customer, right? You could have free customers, premium customers, different types of customers, but they want to know who pays, when they pay, and why will they pay. They really want to understand the unit economics. You don't need to have perfect data for unit economics, but investors do really start with unit economics. Having TAM, SAM, SOM is good, but at unit economics level, if we are not able to show a break even or a profit margin, then it's really difficult to scale to a large volume in a short time. So that's the logic that's applied. So have your unit economics really solid, may not be perfect, but TAM, SAM, SOM is not sufficient. It's also important about the revenue logic, right? So tie capital to milestones. When you receive capital from the investors, say that this is the milestone 1 we plan to hit, this is the timeline, and so on and so forth. Because also very important to have a good final slide, because investors see multiple decks a day. Last slide is more likely the most they will remember. So have strong visuals, forward-looking statements, what you do, why it matters, and so on and so forth. And this is a quick summary of all the 10 slides. And if you have any questions, feel free to reach out to me. You can scan QR code and learn more as well. Now, I think we are kind of getting close to time. So in the interest of time, I'll just give a high-level view of additional topics that we typically cover in a fundraising mastermind. So one other thing that we need to care about beyond the 3 phases and the 10-slide deck is metrics. Metrics, not all types of metrics, but metrics that really matter to investors. So investors look at metrics as signals. Is there a cause and effect inside your business? At the early stage, investors are scanning for how are users finding you, why are they staying, and who has already tested this in the real world, not in an alpha or a beta, but in the real world. So that's the kind of metric that we want to focus if we are reaching investors. In terms of investor readiness checklist, it's all about predictability, in the sense, assuming what the investor may need and having them ready before meeting the investor. It's really the difference between saying, okay, I'll follow up when an investor asks a question, versus sending a link immediately. Hey, you asked me a question in our meeting today. Here is the data, the proof point that I have. Sending it immediately really makes them to follow up and get more information from your product or solution. Having a clean cap table, organized data room, financials, defined use of funds, these are all part of the investor readiness checklist. And again, when it comes to due diligence, many founders think of it as an interrogation, but it's more a confirmation, because we also need to understand the investor perspective. They are investing their funds, expecting a future return of investment from you, which means they are risking their business, their investment, sometimes in angel scenarios, their personal funds, which means it's important for them and also for you taking funds from them to have a successful due diligence. If you're in diligence, you should be really proud that you're already on the shortlist, that it's more validation at this point, not necessarily are they interested. But if there are things that you see as a gap, it's important to surface it early, explain your mitigation plan to the investors upfront instead of, having them find out and then you trying to, patch it up. That never goes well. And the last thing is having metrics is not just important. Instead of listing percentages, explain outcomes, right? For example, something like we changed customer onboarding, customer retention improved, and that tells us XYZ. It's really difficult for investors or anyone looking at numbers and assume what you are thinking in your mind. So it's our job to ensure that the metrics provide the right narrative and the before and after scenarios to the investor. So we protect ourselves in terms of what we want the metric to help us versus not helping us in the fundraising journey. Again, these are some additional topics we can deep dive in a mastermind, like how do you design your outreach system? How do you craft effective investor updates? How do you plan your next week investor actions? How do you maintain the relationship with the investors? How can you build a fundraising toolkit? Now you're running your business. How can you integrate fundraising with your business operations so it doesn't feel like you're running two different businesses at the same time? How can you integrate them so that one feeds into the other? And what are some common fundraising pitfalls that you can avoid before meeting the investor? How can you really make the 12-week sprint more efficient and productive? So here's more information about the mastermind. You can check out the website, email me if any questions. And the last thing is, if you plan to be in New York for the FinTech Week that's coming up in April, don't miss out to submit interest at the startup pitch competition, or simply just join us, attend and meet with investors and angels. We are focusing more on FinTech, AI, and deep tech sectors. It's on April 20th. Check it out. So again, a little bit more information on Wallet Max. Happy to talk more offline. But in closing, I just want to reframe that fundraising is more an operating discipline. You already know how to build products and teams. We just want to apply the same rigor to fundraising. So today, the one ask is commit to one action, block 30 minutes in the next 2 days, and use one tool from today's session. You can look at the step-by-step 12-week plan, pick one metric, one deliverable, one thing you can do this week in the next couple of days, and make week one next week in your sprint journey. And again, if you have more questions, happy to chat more offline on LinkedIn and otherwise.
Thank you. Thank you so much, Buva. There have been a number of questions that have come in the chat. So I would love to kind of just feed them to you. And then, those of you listening, if you have additional questions, just keep them coming in the chat. So maybe, Kat, if you keep your eye on, new questions coming in, I can field the ones that are already there. So Buva, first couple of questions are related, and they come from Micah. And she's asking, so how do you get warm intros? And then kind of a related question, do you cold email partners and GPs directly by getting their emails once your deck and financials are, quote unquote, perfect? I love your optimism, Micah. Experience is never perfect, but I love that. Okay.
Yeah, it's never perfect, but two things. One is warm introductions is where you join communities, you connect with people like Kat, Green, myself, or there are several other communities out there. You go to networking events, virtual or in person, find mentors and advisors or speakers who know investors, build a relationship and ask for a warm intro. A warm intro goes a very long way than cold outreach. In a scenario where you have zero warm intros, you have to rely only on cold outreach. That's what I already mentioned. Don't try to send generic emails that blast out 1,000 emails to 1,000 investors. Try to take time to list 50 to 100 cold outreaches but personalize each email. Why are you trying to cold outreach this investor? Is it the sector that interests you? Do you know they have launched a new fund they are trying to deploy capital? Do you know they are focusing on a specific stage at this point in time? There is change in industry, economy, or trend. Have that upfront and write the cold outreach email. 9 out of 10 times that gets the attention. That's why we need to also keep providing weekly updates. As an example, week 5, you send one cold outreach email. Week 6 and 7, try to send investor updates. What's your progress? What do you plan? Next steps? Are they open to a meeting? You should definitely try to hear back within the week 7, 8, or 9. Assume you don't hear back from this investor. It may not be even about your problem or solution or your product. It could be that they are not actively deploying capital at the moment. So instead of spending time trying to chase the same set of investors, find the next set of 100 investors. But the best way to get an investor attention and have a meeting, more likely in person or virtual, is to get warm intros and through networking.
Well said. I agree with all of that. Charles Garrett has a question. How possible would it be to compress this program down to 6 weeks? I don't know if you've gotten that question before.
I've gotten that question before. Many times founders want to, collapse that phase 1. They think they are always ready and they are ready to engage, start from week 5 and go into week 8 or compress that into 6-week timeline. And that's what I already mentioned. It's really important to have everything in place before you have the first meeting, because it's very unlikely you get a second meeting when you go to the first meeting and see there are missing elements and you say, okay, I'll come back to you in 2 weeks. Rather, if you put this upfront effort of those couple of weeks, then it's really easy to meet even 5 investors in a day or 10 investors in a week, instead of going back and updating the pitch deck and coming back and asking them for a second meeting, because by the time is lost and they have lost interest. So I've gotten this question, can I collapse the preparation phase? It's really important that you spend time in the preparation phase. It's like your product building. You spend time on your design and the MVP and the prototype that really meets the customer needs first before you go and build it, not build it and expect the customer to like it, right? It's the same principle.
No, that's a great answer, Uva. Okay, another question from Tosca. I just built a custom dashboard. Oh, this is more of a comment than a question. I saw this. I loved it. I tried to heart it. So Tosca built a custom dashboard on Claude yesterday. It tracks her pipeline, LinkedIn outreach, and strategy calendar. That sounds really cool. I did personally find it super helpful when you outlined, what should be put in the spreadsheet as like the weekly check-ins that you have with yourself, like every Friday for 15 minutes, like what those different metrics are. And I had the same thought that maybe Tosca had, which is how do you automate that and take it away from a spreadsheet? Because like I hate spreadsheets. So I don't know if you maybe have something to say about what Tosca did.
Yeah. Why I said a simple spreadsheet is sufficient, because sometimes founders try to spend a lot of time to perfect this metrics dashboard before they outreach. But you could start as simple as a spreadsheet, but there is absolutely all possibility to automate this. It's same as how you automate your business operations, how you track your customer metrics. If you have a CRM system, you can easily plug in these metrics to be tracked within your CRM platform. You can use Notion. There are a lot of free open source tools available. You can leverage one of them, but we can also talk a little bit more on how we can automate this. The goal is your business metrics should automatically feed into your fundraising metrics and vice versa. We don't want to build 2 separate things and manually try to track, which also adds a lot of overhead and takes away energy. The goal is to integrate your fundraising with operations and automate together.
Yes, amazing. Okay, so another question from the Raw Girl. How do you pivot if you do not close the full round within 12 weeks, noticing some founders are closing in a much longer time frame? How does that work? Are they continuously moving their close date?
No, so you do not continuously move the close date. When you are in week 11 and 12, if you think you have not progressed sufficiently, then you have to go back and revisit the type of investor, the check size, the sector you are targeting, and revisit the list of people you tried reaching. Why did you not close? Is it because you reached investors who were not actively deploying, but they were a match? Or is it a difference in terms of your expectations to close in 60, 90 days and their process that closes only in 6 months or 9 months, right? So it's really important to have lessons as to where it had the delay and fix that and outreach to different set of investors or reach the same investors with different materials. Those are more likely the scenarios if investors are really actively deploying capital. If they are not actively deploying capital and you had them in your investor outreach list, it is very likely that you may not close the round. So find out the top 3 to 5 reasons why it did not close. Talk to advisors, mentors, talk to other founders, and narrow down the list or the process or tweak the materials to outreach.
So, and to be clear, then if you miss that deadline, then you are circling the wagons, doing your research, and then you're launching a new round.
Correct. So within the first 12 weeks, if you have not been closing, then the 12th week is also more a reflection week. Where did it fail? And you restart in the 13th week with a revised investor outreach list. And this is a scenario where you don't need additional 12 weeks because you've already done the preparation. You just have to engage differently with the different types of investors. So week 13 would be your new week 5 in terms of having a new list. And it need not be 12 weeks. It could be 4 more weeks of outreaching new investors and having meetings.
Okay, and I guess kind of implicit in what you're saying is that if you're targeting new investors, then they may not even have heard about your previous round. So you don't need to feel bad about, oh yeah, I was telling everyone it was closing in September, but now it's October and I'm telling everyone it's closing in January, because you're talking to different audiences. So they don't know that you always have a round open.
Yes and no. Investor network is also a very tight-knit network. They talk to each other, and it is actually not a problem if you say that you plan to close and you know exactly why you didn't close and you are transparent about it. It is not ideal to assume that investors don't talk to each other and have 2 different stories. It is always better to assume that they talk to each other and be transparent that, yes, I wanted to close it in September. I did not, and here is why. So I am engaging again, but I have all the preparation materials ready, so I don't have to go and redo everything.
Yeah. Okay. No, love that. And sorry, I'm asking all those questions because I just know people are really confused on this. And so it's very helpful to hear your strategy that you're recommending. Okay. So from Cassandra. Hi, Cassandra. Good to see you again. How do you feel about a teaser deck to get the conversation going? So less reason to say no, but enough to just pique their interest, and then provide the longer deck when you get on a call. She's seen some founders be successful with that.
Yes, definitely. So I also mentioned something called investor one-page thesis, memo, or a summary. Sometimes that helps get into the door. Let us say where that helps. If you're in a networking conference or a discussion where you're meeting the investor on the road and you have like less than 5 minutes to talk to them, you can just show them a quick 1-pager or a teaser deck. Teaser deck means I hope it has 1 or 2 slides, not 10 slides, so that within those 5-10 minutes, they are able to grab it, and then you can tell them you'll send a detailed deck after you get to your place or whatever that is. But even that 1-pager, whether it is 1 page, teaser deck, or 10 slides, the critical items that definitely need to be addressed are problem, solution, market traction, business model, who's paying, who's willing to pay, what is your growth plan when you get the funding closed, and definitely the team, not everyone in the team, but key players. If these 4 or 5 things are not there, doesn't matter whether it's a one-pager, piece of deck, or a big deck, they won't be able to comprehend to have a second discussion with you.
So helpful. Okay, amazing. Those were my questions. Kat, have there been additional questions?
No, but I guess I have one because it just pertains to what we're doing, because we are also fundraising, but we have had a couple of warm intros and now we have an amazing live demo. Would you ever suggest sending out live demos to investors?
Yes, live demos are great, but it may not be 10-20 minute demos, just a teaser. And this is where it's really helpful to keep it to less than 3 minutes or so that they get a feel for the important aspects of the product, not necessarily the end-to-end view. Critically, what pain point it solves, how it solves, how do you make money. If these 3 things are visible in that demo less than 3 minutes, definitely send it with your initial outreach. Ensure there is no sensitive data, obviously protect your privacy and things of that sort, but they do not like password protected links that are behind links that are having difficulty in terms of requesting access. Maybe put it on YouTube or somewhere so everyone can see it, easily accessible. The less friction we have to get their attention, the faster we can get a second meeting.
Amazing. Great. And actually, I did miss a bunch of questions, so apologies. Pitts has put a bunch in the chat. So how do you time-bound investment window for investors without looking desperate?
Without looking? What is that?
Desperate.
Yes.
So creating that sense of urgency. How do we do it?
Yeah, so creating the sense of urgency, I think I mentioned in one of the slides earlier, where having a structure and telling them, hey, we have all the preparation, we have reached out to 20 investors, we have interest from 10 of them who want to have meetings with us. If you really want to have a meeting with us sooner, then here are some options so that we can figure out what works for us and what doesn't work for us, right? It's really important to share why you are trying to specifically ask a set of investors for a meeting sooner than everyone else. It's definitely not a good scenario to look desperate, because then your valuation and terms could be really very low, and there could be opportunities where someone else may not give you what you want. So without looking desperate, trying to showcase transparently, hey, we have 10 investors who have meetings lined up in the next 2 weeks. Would you like to be in the first set of investors who want to talk to us so we can find alignment? I really want you to be my investor, and here is why. Because you focus on a sector I like, you focus on a fund that really invests in set of people that we cater to, something of that sort that puts them in the priority list without looking desperate. Never show that you are desperate.
I love that. Making it give them more of a reason to believe that you're giving them an opportunity versus an
prioritize. Mm-hmm.
Yeah.
To prioritize them. Mm-hmm.
Yeah. Okay. Pitts, you raised your hand. Do you want to come off mute and ask your question? I know you have multiple ones in the chat.
Yes. Thank you for that. And so my name is Santa Gaspard. I'm the CEO of a medtech company, an AI-driven platform called Redetection, focused on data-driven analysis and care management for chronic derms, wounds, and cardiovascular health monitoring. So my following question is, what does it look like to integrate operational with investment metrics? So when you said, oh, it's important to do that so that you can show that you're still making progress while fundraising and that there are free tools to do that. What's an example of what that looks like in a real world setting where you're fundraising and running your business and there's a tool that's merging those two together? And what's the name of that tool?
Okay. I'm not able to share the name of the tool publicly, then it would mean that I'm attesting or supporting that tool. If you don't mind, just drop a message on my LinkedIn or email me. I'm happy to share more information. But in terms of the scenario where operational metrics should feed into fundraising metrics is, like I mentioned, in week 1, let us say you had 20 customers who were willing to pay, let us say, subscription tier 1 model. You are sending updates to investors in week 5, 6, and 7. If the 20 has not changed in week 5 and 7, that's a red flag. That's why you don't want to also manually update that. So the customer traction metrics should automatically feed into your fundraising metric, meaning between week 1 and 5, 6, 7, there should be a change in that 20. If the change is not positive, don't try not to send the update. It is really appreciated by investors where we say, I started with 20, we were at 40 in week 4. In week 5, we lost 5 customers, and here is why we lost them, and we know how to fix them in the next 3 weeks. It is okay to send a week 4 40 number in terms of customers and 35 in week 5 and explain why and how you plan to fix it versus trying to avoid sending that data. That's what I meant, integrating operational data into fundraising data, because they also want to see a progression while you're fundraising. It should not be the data from week 1.
Okay, so in the email outreaches to investors, we should have growth metrics, like quick updates of here's where we are. We're talking to 2 customers, 2 partners. Then by week 4, we need to be like, we're talking to 10 customers, 5 partners. And then that, so when you say overlapping, you just mean sharing the metrics with them.
Correct, but also explaining what that metric means. You can perceive 10 customers and 5 partners differently from someone else who has no idea about how you run your business. So it's really important to showcase, okay, we have grown from 5 customers to 10 customers, and here is what it means for the growth trajectory of our business. Having that simple narrative in the progress update on a weekly basis is important. So you don't try to convey something versus the investor understands something else that's not beneficial for your fundraising. So having metrics, but also giving a 1-line, 2-line narrative of what it means to the investor in terms of your business growth and traction.
Okay, and then a quick final follow-up question. In your presentation, you said that we needed to show investors the why now. What's a quick way to do that? That's not, oftentimes the why now, you have to kind of show, here's how we're better than competitors. Here's what's going on in the market right now. That could be a lot to include on one slide, but is there an easy way to communicate why now?
If you have multiple why nows, it's really important to pick 1 or 2 and put it in the slide. But it's really important because let us say you are building something that may not be relevant in the current market, then investors are not going to switch through slide 4 or 5. So if you have like 10 different why nows, mention 1 or 2 and mention in the outreach email that you're happy to share more, but not having a why now up and center at the start of the deck is really going to be difficult for investors to understand how to invest in this business, because they're investing in this business to get some ROI or returns in the next 12 to 36 months and then scale in the 4th and 5th year of the business. For them to visualize that your solution matters, it solves a critical pain point now, and customers are looking for it today, not 5 years back or 5 years later, is important. So if you have multiple why nows, I suggest choose 1 or 2 and put them front and center.
Okay.
Amazing. And we are past the hour, so just to be cognizant of everybody's time, thank you so much. I think your last comment is just, I think it's great. It's creating that sense of urgency around your product.
Yes.
To get people excited. But as Buva mentioned, she is you can reach her and contact her for if you have more questions. Buva, this was an amazing presentation. Thank you so much. Thank you everyone for coming. And the more we talk about the challenges, the more we're normalizing them, the more approachable and less overwhelming they will be. So valuable content. Thank you so much. And I hope to see everyone here soon. again.
Thanks,
a
everyone.
great-
Thanks, Kat and Breen.